Welcome back to the continuation of our Chapter 17, Corporations, the Introduction and Operating Rules. So the previous video left off with employee excessive compensation. Now we are going to move into NOLs, net operating losses of a corporation and individuals may be carried forward indefinitely to offset taxable income for those future years. The NOL deduction for any carryover year is limited to 80% of taxable income. Now, unlike individuals, a corporation does not adjust its tax loss for capital losses, since a corporation cannot deduct net capital losses. A corporation also does not make adjustments for any non-business deductions, and a corporation is allowed to include the dividends received deduction in computing NOL. And here is that dividends received deduction. So if a corporation owns stock in another corporation and receives dividends, a portion of those dividends may be deducted from the income. And you'll see if it's less than 20% of ownership, you can deduct 50%. 20% or more, so between 20 and 79%, you can deduct 65% of those dividends. And 80% or more, 100% is deductible. So the dividends received deduction is limited to a percentage of the taxable income of a corporation. So for this purpose, taxable income is computed without regard to the net operating loss deduction, without regard to the dividends received deduction, and without regard to any capital loss carryback to the current tax year. So the percentage of taxable income limitation corresponds to the deduction percentage. However, the taxable income limitation does not apply if the corporation has a net operating loss, NOL, for the current taxable year. The following steps are useful when you're calculating the dividends received deduction, DRD. First, we want to multiply the dividends received by the percentage deductible, as we mentioned earlier. Then you want to multiply the taxable income by that same deduction percentage. You're going to subtract step one from your taxable income, and the resultant, if an entity has income before their dividends received deduction, but the dividends received deduction creates or increases our net operating loss, the amount in step one is the dividends received deduction. This is known as the net operating loss rule. But if the dividends received deduction does not create or increase NOL, the deduction is limited to the lesser of the first two steps. Now moving on to organizational expenditures. So a corporation may elect to amortize organizational expenditures over a 180-month period, beginning with the month in which the corporation begins business. So a special exception allows the corporation to immediately expense the first $5,000 of these costs. And then it's phased out on a dollar-for-dollar basis when these expenses exceed $50,000. Organizational expenditures include legal services that is incident to the organization, any necessary accounting services, expenses of temporary directors and of organizational meetings of those directors and shareholders, fees paid to the state for incorporation, expenditures connected with issuing or selling shares of stock or other securities, or with the transfer of assets to the corporation do not qualify. Those expenditures reduce the amount of the capital raised and are not deductible at all. Now let's talk about startup expenditures, which include various investigating expenses involved in entering a new business, such as travel, market surveys, financial audits, and legal fees. Also including operating expenses is rent and payroll that are incurred by the corporation before it actually begins to produce any gross income. At the election of the taxpayer, these expenditures can be treated in the same manner as organizational expenditures. So up to $5,000 can be immediately expensed, and then it's also subject to the dollar cap in excess of $50,000 phase out, just like organizational expenditures. And any remaining amounts are amortized over a period of 180 months, and it's also available to non-corporate taxpayers. Now we have the corporate tax formula, which begins with gross income. Then we reduce the deductions. And then we have the carryback of domestic production activities, which gives us the taxable income, which is subjected to the charitable limitation. Then we subtract the charitable contributions, which is limited to 10% of the taxable income for charitable limitation. And then the resultant gives us taxable incomes for the DRD. Then we reduce the DRD, the dividends received deduction. That gives us our taxable income before any carrybacks. Then we can reduce the NOL carryback or the STCL carryback to get our taxable income. So the corporate tax rates, the TCJA of 2017 reduced the tax rate to a flat rate of 21% for the tax years beginning after 2017. And then we have AMT's alternative minimum tax. So prior to the enactment of the TCJA of 2017, corporations were subject to an alternative minimum tax, very similar to what individuals had to pay. But now the TCJA of 2019 repealed the corporate AMT for any tax year beginning after 2017. Then we have our corporate filing requirements. So every corporation must file a Form 1120 on or before the 15th day of the 4th month following the close of the tax year, even if it has no taxable income. An automatic 6-month extension is available if we file Form 7004, and most corporations do file an extension. And then we have to make estimated tax payments equal to the lesser of 100% of the corporation's tax for the current year or 100% of the tax for the preceding year. No estimated tax payments are required if the tax liability is expected to be less than $500. Then we have a Schedule M1 that corporations must reconcile their financial accounting income with the taxable income on the Schedule M1 of the Form 1120. So the common reconciling items include your federal tax per your books, your net capital losses, your income reported for tax but not book income like prepaid income, and expenses deducted for book income but not tax like your excess charitable contributions. And then we have a Schedule M2, and corporations must reconcile their retained earnings at the beginning of the year with the retained earnings at the end of the year using Schedule M2 of the Form 1120. And Schedule L, which is the balance sheet, Schedules M1 and M2 are not required if the corporation has less than $250,000 of gross receipts and less than $250,000 in assets. And we move now on to Schedule M3, where corporate taxpayers with total assets of $10 million or more are required to report much greater detail regarding the differences in their financial accounting income and their taxable income. And this is reported on Schedule M3. And what Schedule M3 is providing us greater transparencies between corporate financial statements and tax returns. And it helps the IRS identify corporations that engage in any aggressive tax practices. Now we have consolidated return advantages. So current losses can be offset against income of other members and reduce the current regular tax or our AMT. So shareholders of all group members can be used in meetings other than statutory requirements. And then we have taxation of intercompany dividends may be eliminated with this consolidated return. And then income on certain intercompany transactions can also be deferred with a consolidated return. And consolidated returns, there are certain deductions and tax credits that can be better utilized when the subject is limited to limitations of the overall group rather than the individual members. And with a consolidated return, the basis in the stock owned is in lower tier entities is increased as income is reported. And the election is binding on all members for current and all subsequent years, and the election may be terminated if the IRS consents to revoking it, or if the members in a group changes and a new member is not included in that election for the corporate consolidated returns. So losses on intercompany transactions are deferred, and you use the parent's tax year, and that creates shorter tax years for the subsidiaries. Those are some disadvantages to consolidated returns. Additionally, another disadvantage is that the basis in the stock owned in lower tier entities is reduced if losses from the subsidiary are reported. And with consolidated returns, there is an additional reporting requirement that exists, and there is additional administrative procedures that are necessary to file that return. So electing a consolidated return status, so a corporation can elect to join in a consolidated return if it is a member of the affiliated group, it is not ineligible to file on a consolidated basis, and it meets the initial and ongoing requirements. So computing your consolidated taxable income, there is a sequential approach where you compute the taxable income separately for each of the members of the group. Then you group items and intercompany items. Those are isolated and those receive special tax treatment. And then the remaining separate incomes are combined with group and intercompany items, and then you get the consolidated taxable income. So this computational procedure allows several transactions to be accounted for on a consolidated basis, such as charitable contributions and capital gains and losses. But those gains and losses from certain intercompany transactions are deferred until a later tax year. And a few intercompany transactions are removed from the taxable income calculation altogether and never appear on a consolidated return, such as dividend payments. So now we have the Schedule M1 tax return disclosures. So this is pretty much used to reconcile book income to taxable income, and it contains positive and negative adjustments for both temporary and permanent differences. Keep in mind that Schedule M3 is required for a C Corp or consolidated tax return with total year-end assets of at least $10 million. So an income tax note on the financial statement also contains a tax reconciliation, but the purpose and content of this reconciliation are different from your footnote disclosures on your financial statements and your M1 through M3. Schedules M1 through M3 is typically the starting point for IRS or audits of corporations because these schedules identify large differences between books and taxable income, which may offer the IRS auditor insights into any tax saving strategies that the corporation might be participating in. So here's an example of a Schedule M1 directly taken from the Form 1120. Now let's talk about GAAP principles. So income tax expense under ASC 740 is made up of both current and deferred components. So let's talk about current tax expense, which theoretically represents the taxes actually paid to or refunds received from the government. Deferred tax expense, or DTB, deferred tax benefit, represents the future tax cost or savings connected with the income reported in the current period financial statement, and it is created as a result of temporary differences. So ASC 740 adopts a balance sheet approach to measuring deferred taxes. So under this balance sheet approach, the deferred tax expense or benefit is the change from one year to the next in the net deferred tax liability or deferred tax asset. A deferred tax liability is the expected future tax liability related to current income measured using the enacted tax rates and rules. A deferred tax liability is created in the following situations. For example, an expense is deductible for tax in the current period, but it is not deductible for book until some future period. Another example is income is included currently for book purposes, but it is not includable in taxable income until a future period. So in essence, a deferred tax liability is created when the book basis of an asset exceeds its tax basis. The opposite condition would create a deferred tax asset. A deferred tax asset is the expected future benefit related to current book income, measured using enacted tax rates and rules. So a deferred tax asset is created in several situations. For example, an expense is deductible for book in the current period, but it is not deductible for tax until some future period. Income is includable in taxable income currently, but it is not includable in book income until a future period, would also result in a deferred tax asset. Deferred tax assets and liabilities are reported on the balance sheet. Deferred tax liabilities represent an amount that may be paid to the government in the future. So in essence, it's an interest-free loan from the government with a due date perhaps many years in the future. A deferred tax assets are future tax benefits similar to a receivable from the government that may not be received until many years in the future. And we have reached the end of our chapter 17, Corporations, Introduction, and Operating Rules. Thanks for listening.